The broader market opened today staring down serious geopolitical threats, yet tech stocks rallied straight through the noise. Overnight, the Islamic Revolutionary Guard Corps issued direct warnings of imminent strikes targeting Middle East facilities owned by U.S. corporations, including major tech firms. Instead of triggering a sell-off, the major indices absorbed the headline completely. By the closing bell, the Dow added 224 points, and the S&P 500 closed up nearly 0.75%. The real rotation of capital went straight into mega-cap tech. The Nasdaq outperformed the rest of the market, posting a 1.16% gain as institutional money sought safety in large tech equities. This chart tracks the VIX, the market's primary fear gauge. We can see the exact moment risk appetite returned, with the index dropping sharply by 2.81% to settle at 24.54. When aggressive external headlines are met by a complete dismissal from the tape, it creates a specific opening. It allows us to hunt for alpha in the individual stocks that are actually driving that resilience. Leading the charge for the Nasdaq today was Alphabet Incorporated's Class A shares, trading under the ticker GOOGL. Looking at this intraday chart, GOOGL maintained a strong upward trajectory all session, logging a 3.42% gain and closing the day at $297.39. This move was backed by serious liquidity. More than 37.5 million shares changed hands, signaling heavy institutional participation rather than retail speculation. Zoom out to the year-to-date timeline, however, and GOOGL is still down roughly 5% for the year. That discrepancy is a significant signal for active traders. The stock has been lagging its peers for months, but today's heavy volume surge indicates a sharp technical inflection point. GOOGL is now bridging the broader market's resilience with its own isolated technical breakout, offering an asymmetric setup for active capital deployment. Any technical swing trade requires a baseline of fundamental stability. Alphabet operates with a fortress balance sheet, which provides a concrete floor for the current valuation. This bar chart compares Alphabet's top-line revenue over the last year. Q4 2025 revenue hit $113.83 billion, an 18% increase year over year. The bottom line expanded even faster. Net income surged to $34.46 billion, representing a nearly 30% jump over the same period. That growth translates to a 30.27% net profit margin, proving the company's ability to maintain high-margin operations even at this massive scale. Right now, the stock trades at a price-to-earnings, or PE ratio, of 27.52, but the forward PE ratio sits lower, at 22.08. Analysts expect Alphabet's future earnings to outpace its current stock price. When top-line growth is paired with a compressing forward multiple, the fundamental floor becomes much easier to identify. This valuation support provides a mathematical buffer for the capital we're putting at risk in a shorter-term trade. Beyond the balance sheet, Alphabet is actively weaponizing its product cycle against competitors. Today, Google issued a stark warning regarding the rapid advancement of quantum computing, labeling it Q-Day. Q-Day represents the threshold where quantum computers become powerful enough to crack Bitcoin's encryption, an event Google now projects could happen by 2029. Simultaneously, Google unveiled a new AI algorithm today that radically reduces memory consumption by a factor of 6. The release of that algorithm had an immediate ripple effect. Because the software is so efficient, it triggered a massive sell-off in memory chip manufacturer Micron. In a single trading session, Alphabet threatened the encryption of a trillion-dollar asset class and cratered a major semiconductor supplier. They are dictating the tech sector narrative. Taking a long position in GOLGL right now means you are deploying capital into the market's primary disruptor. However, there is a critical bear case that contrasts with these bullish headlines. To gauge real executive confidence, we have to look at SEC Form 4 filings, which track insider trading. Right now, Alphabet's C-suite is systematically liquidating stock. That selling is being led by CEO Sundar Pichai. Throughout the first quarter of 2026, Pichai has been unloading identical blocks of 32,500 shares roughly every 2 weeks. He's not the only one. Other top executives, including Chief Legal Officer John Kent Walker, are also cashing out millions of dollars in equity. This creates a headwind for the stock's trajectory. When the executives running the company are constant sellers, it can place a psychological ceiling on institutional support. This systematic liquidation creates a notable divergence between the company's bullish news cycle and the executive's own financial actions. For an outside investor, that makes a tactical swing trade an attractive way to capture the current momentum without ignoring the signals coming from the top. Executing that swing trade requires strict mathematical parameters before a single dollar is deployed. The first parameter is position sizing. A disciplined trader will allocate a maximum of 1 to 2% of their total portfolio equity to the risk of this single Google setup. Next, we calculate the stock's beta, which measures its historical volatility against the S&P 500. Google currently has a beta of 1.13. That means it will move 13% more aggressively than the broader market in either direction. Because of that amplified volatility, you must predefine your exact stop-loss exits before you ever hit the buy button. Relying purely on fundamental bias is dangerous. Strict risk management is the only mechanism that prevents a temporary swing trade from turning into a long-term, toxic hold. This chart maps out the official architecture for the hypothetical Google swing trade. The technical setup here is a post-pullback momentum continuation. We can clearly see the underlying support zone. The stock is currently trading 4.4% below its 50-day simple moving average. That gap establishes our entry zone. Traders should scale in between the $290 level and today's close of $297.39. Our first take profit target, or TP1, sits at $349, where the price will test its previous 52-week high. For the remaining runners, the secondary take profit target rests at $378.77, aligning with the aggregate analyst price target. The absolute invalidation point requires a hard stop loss at $275. This acts as a circuit breaker against broader macro breakdowns or sudden insider dumping. Structuring the entries, targets, and stops at these levels ensures a minimum 2-to-1 reward-to-risk ratio. The data confirming this setup was pulled from Google Finance, Finviz, MarketWatch, Barron's, and Guru Focus. In a market dominated by emotional headlines, professional traders strip away the noise. They trust the data, respect the risk, and relentlessly execute the architecture.